Morgan Stanley analysts said that oil will likely be in a surplus in Cal 25, bringing prices to their estimate of the mid to high $70.
I mean, that's relatively significant for me because, again, people are looking for these analysts to shape, consensus views. And for a long time, maybe 5 years, we've had basically all analysts bullish, but Citigroup bearish. And that's been the state of affairs. So for Morgan Stanley, like a new bank to be bearish is actually, that's new. So I think sometimes, at the end of the day, what they're all doing the same thing. They're looking at the supply and demand modeling. They're putting in their assumptions, and it's all about those assumptions, which gives you their base case. And you have to do a lot of manipulation of the data to get you to a bullish view. It needs a lot of growth and economic demand. That's why OPEC have been very vocal about the growth of 2.5 million barrels a day, which coincides with their cuts. And people, I guess, who want to be bullish are trying to go along with that, but I think it's a very hard thing to do. And Morgan Stanley clearly have just gone, look, this is just not. When they say it will likely be in a surplus, to me, that's as good as saying this is definitely going to be in a surplus. We can't get it to work. Like, we'd just be lying. Anyway, that's because it's just they're 99% of the time bullish, all these banks. So for them to be bearish, it just means how are they going to justify it to clients if you scrutinize the data? But on the flip side, as you said last week as well, Vincent, like the one thing that's still bullish, we can't deny, is the underlying what we call structure, right? Time spreads. And again, to repeat, time spreads are really important because they are actually reflecting a physical differential. There's a very strong link with the physical, much more so than the outright flat price. So when they are in the dollar per barrel range, which it is just about in Brent or just below, but definitely so in WTI, undeniably that is strong, right? And so strong that, something must be going on. Either it's very well propped up, kind of to the point where it actually is costing money to keep it that high, or the markets are that strong. And that is the debate the market will be having right now. But when you start to see these sell-offs like you had on Friday, you could also add to the fact that, people want to see buying throughout the day, and then opportune moments where you think the market kind of won't notice, you kind of put in a bit of selling flow and you start to use things as a liquidation event because you don't actually believe in this recent rally. That's very common, right? It's all about perception. You want to give the market a perception that it's got bullish momentum, and you'll see, it's hard for us to understand, given our trading size. We're very high frequency, very high volume, but not on an outright basis. We're not going to buy 20,000 lots of flat price, but there are quite a few firms who can do that. So in other words, I remember seeing someone even quoting on the FT saying it was like, look, if there's like a bearish DOE, Department of Energy statistics out, and the market's starting to sell off, what's buying a few thousand lots when you've got 100,000 lot position on? You buy a few thousand, it supports the price, maybe even causes like a temporary bullish impetus, and then people then interpret the data differently because they go, the market's reacting bullishly to bearish stats, so it must be bullish. So you want to have this sense of like momentum in the market when the market is paying attention. And then when people go behind closed doors, you can offload, and you want these opportunistic moments. But this time round, you're selling into settlement 7:30, and sometimes there's just not the liquidity there, even though it's usually quite a good time for liquidity, which does show you like, actually, when you need to liquidate some of the length, the market can't take it. It's another bearish sign for me.